Ever wondered why someone else's mortgage interest rate is lower than yours, even though you guys went for the same fixed rate mortgage from the same bank at about the same time? A slight difference in the fixed mortgage interest rate could lead to thousands, if not tens of thousands of dollars in extra interest payment. Rather than hating the annoying colleague in the office bragging about getting a 4.99 while your bank is stuck with a 5.4, let's try to figure out why a Canadian bank will offer different mortgage interest rate to two individuals for the exact same 3 or 5-year fixed rate mortgage. Is there anything that you can do to get a better rate? Watch to the end and I'll share a bonus tip. But before going there, let's do a quick mortgage interest rate 101. The baseline interest of your fixed rate mortgage is typically based on the treasury bond yield at that time. There are other factors as well, but by far bond rates is the most important one. In simple words, that means if a 5-year treasury bond yield is at 3.5%, the bank will offer you a rate somehow 1.5% to 2% higher than that. Different lenders might still show marginally different rates on their website. And also, some lenders might update their interest rates sooner than others in response to the change in bond rates. So you might see different rates depending on the timing and which bank that you are checking with. Obviously, these are the things that you can't control. But then rates might vary even within the same bank based on certain factors. First, if you stay in your purchased property, you will get a lower interest rate. But if you rent it out, you can expect a slightly higher interest rate because you'll be using this property as an investment. The second important factor is your credit score, which acts like your financial report card. Lenders usually don't make noise as long as it's above 680. But if fall below that, you might see your interest rate start climbing up. Third, some professions often get preference when it comes to interest rates. CIBC, for example, offers a lower interest rate to medical professionals. You may call this a special treatment, but I guess every job has its own perks and pains. Fourth, buying a house under $1 million with less than 20% down can secure a lower interest rate, particularly for a 5-year fixed mortgage. It may seem odd that a smaller down payment would mean a lower interest rate. This happens because any down payment lower than 20% legally requires a mortgage default insurance. This insurance protects the bank if the buyer cannot pay the mortgage, therefore lowering the bank's risk and resulting in a better interest rate. If you find my content helpful, I would really appreciate if you can press the subscribe button. More subscribers means that I could reach more people and you will get notified as well whenever I publish new content. Fifth, if you buy a property with more than 4 units, some banks consider it as a commercial mortgage, and that definitely attracts a higher interest rate than residential mortgage, and it also has different terms. But there are exceptions. RBC, for example, allows you to buy a building with 6 units under residential mortgage, and with Desjardins, you can go up to 9 units. And now the bonus tip that you all have been waiting for. Establish a solid relationship with your mortgage broker, preferably someone who works not just with one bank, but with different lenders. If you have a good salary and you can comfortably qualify for an A lender, then you have leverage. Request your broker to shop around and negotiate a better rate for you. And by the way, that's your right. These are not my words. This is guidance coming from Bank of Canada. You can refer to the link below, just that it's not in the best interest of your bank to tell you that. An experienced mortgage broker knows exactly how to negotiate with different lenders. And if they are really client-focused, they will help you save every last dollar in interest rates. And you might think, why they will spend the extra time on you? Because if they are smart enough, they will know after 3 or 5 years during your renewal or refinance, you will go back to them if they provide you excellent service now. There you have it. Mortgages are not just numbers. They tell a story about you, the nature of your mortgage, and most importantly, your choices. If you buy the property with more than 4 units,